morning, everyone. I would like to call this meeting to order. Thank you for joining us during our weekly hybrid MLS breakfast meetings. My name is Tseng, and I'm your February program chair. A little bit about myself. I am a broker associate at Universal Elite Realty. I've been practicing real estate full-time for 14 years. My experience in real estate includes standard sale, short sale, REO, flipping, multifamily, residential, and I'm slowly shifting my focus towards warehouse buying, leasing, medical office, and some commercial retail spaces. I've been serving as director at WSGVR since 2022. Some of my designations include GRI, CIPS, At Home with Diversity, and I have chaired Global Business Council, YPN, and vice chair in Legislative Committee in the past. And I'm honored to be your February program chair for this month. Now help me welcome our guest speaker, CPA Jeff Huang. Jeff Huang is a seasoned certified public accountant with over 20 years of experience in public accounting, including experience with Arthur Andersen, one of the big four accounting firms, and senior management experiences as CFO and controller, and private accounting experience in one of Fortune 500 firms. He specializes in small and medium-sized business management and tax planning, real estate taxation, and planning, foreign national taxation, IRS audit representation, startup business, accounting and financial reporting, and management and counseling. In addition to CPA and MBA, Jeff is also certified QuickBooks Pro Advisor, Microsoft Certified Professionals, and Microsoft Certified Database Administrator. Jeff likes to play tennis, read books, and volunteer for community service. Let's welcome Jeff Huang.
Good morning. Thank you, Tom. Before I would like to say that I'm very proud of a member of West St. Gabriel's Realtor Association. I've been a member for more than 22 years, but I'm not active. But I'm very thankful for everything our association do to me at the beginning of my career. So right now, my focus is on my practice, CPA. So I don't do any real estate transactions, but I'll be there. So I'm in a good position because we share the same experience. So that I'm in a good position to share with you 2025 tax planning for realtors. Look at next. So here's things I would like to share with you. Here's the agenda. First thing, we talk about 2025, the tax law update relate to our professional as a realtor, and also how to maximize the deduction through realtor. And I would like to draw attention lately with all the AI and lately all the new events here, the AI can spot check things very quick. So I would like to draw attention the IR audit risk and also the red flag for realtors. And I don't think I have enough time. Today I only have 30 minutes. So I have a lot of content here for me to go through. So I wish I had Keeper, but I thank you for to helping me on that. So later I have the Q&A. Keep those in mind. The section is more interactive. If any question, just stop me. So the first thing I would like to share with you, the common challenge for us as a realtor. First one, our income change. So it's not like the stable income. Like your W-2 and every month you have stable income. Some months will have high income, some months have low income. And maybe some years good year, some years not the good year. So, and also the things for us, because we're busy helping the client, but we don't have time to take care of ourselves. So sometimes when it comes down to audit, I mean, we might not have enough documentation to back up all the documents. And the other things I would like to draw attention is about self-employment tax. When it comes down to tax time right now, maybe you need to write a big check. One of the reasons, and first thing, you had a good year. But the other reason is because we have the self-employment tax. So which I'm going to address how to avoid and how to minimize the self-employment tax next. Before I start the meeting here, I would like to emphasize there are two things. One is tax compliance. Everything after December 31st, we cannot do too many things. We have to comply. And before, it's called tax planning. Before December 31st, at the end of the year, we can take advantage on all the IR section code. We can plan ahead to minimize our tax liability or achieve a goal. So that's the main factor as the profession, as the realtors. Next. So first one, I would like to give update for the IRS tax relief for Los Angeles counties. Before that, let me ask one question. How many of you live in county of Los Angeles? Everybody. And also we have the client and also live in county of Los Angeles. And I mean, I know that's not fortunate. Some of our clients or some people get filed. And how many of you know the people, their house get burned by the fire? Yeah, so I do have handout to give everybody on the handout. So today I might not have enough time to go through everything, but this is a handout I give you the guideline. So first thing, if you live on the county of Los Angeles, that's a good news to everybody live here. First things, the due date for tax return is automatic extend to October 15. So you don't need to do any paperwork. And the few things about the tax payment and also extend to October 15. That including, which is on the Q4 2024 tax estimate tax payment. They're supposed due by January 15 because the fire happened in January 7. So it's automatic extend to October 15 this year. So that means that if you have any estimate tax payment for last year you haven't paid yet, that's a good news. You can have more time to make those estimate tax payment. And also for the IRA contribution, normally they're due by April 15, 2025. If you live in County Los Angeles, it's going to be extended to October 15. That's October 15. So you still have the time. And also if you have a corporation like S Corp, C Corp, and it's automated extend to October 15. So for those people who suffer on the fire because of the loss, and if any loss, disaster is not getting reimbursed by the insurance, and we can claim for next 2 years in 2025 tax return and 2026 tax return on that. So you can election up to October 15, 2026. And if you ask me the question, you can look up the form 4856DR. That's a form they need to fill out. So the other things, people, they need to take the money out from their retirement account. And normally early withdrawal, that's a 10% penalty. So if you live in County of Los Angeles, and that penalty is waived, so no 10% penalty. And also, you can be, when you receive the retirement, they report the income normally for the year. You can speak for next 3 years. Okay, let's take a look 2025 tax update. So keep this in mind when I prepare the PowerPoint, I have a lot of things to like to share with each of you. So I know that I only have 30 minutes. So I might skip very quick, and also maybe next time, if you need more topic in depth, and let the associate know that I will come out to another speech on that. So first one, take a look 2025. So you know that standard deduction, I have those 2-year comparison. So if you are single, and right now, the standard deduction is increased $400. Same thing for married jointly. Right now, standard deduction is $30,000, which increased about $800. Next. And here is the tax bracket. So as I mentioned last time, in the tax bracket, we have the 7 tax bracket. I would like to draw attention for a few of the tax bracket. So if you read on the left-hand side, we start with 10%, 12%, 22, 24, 32, 35, 37. So let me ask questions. For those 7 tax bracket, do you see the big jump between which tax bracket? Okay, I hear 12, okay, and 30, okay. So I can hear that if you see that if you're on the tax bracket, 12%, and the next tax bracket is 22%. That's 10% jump between those tax bracket. That means that if like you're single, you're making more than like 11,600, and between 11,600 to 47,000, and you have big jump for 10%. So the next tax bracket big jump is between 24 and 32, which is 8% difference. So, I mean, maybe that's most applied to most of you. So for example, we are single, we're making about 100,000. We are on the 24% tax bracket. So if we have make a nice problem, we're making 150,000. We're single, make assumption. So the additional 50,000 is on the next tax bracket, which is 32. Do you see that number here? So the number, it had a big jump. So the 7 tax bracket is not evenly increased. They increase on 22, 24, 24, 32. So that's the big change on that. Next, here's the single American journey here. So the same thing, the big jump between 24, 32, 12, and 22, the big jump. Next, okay. As I mentioned that if you live in the county of Los Angeles, the deadline for the IRA contribution will be extended by October 15. So you still have 6 more months. So take a look at IRA. Traditional IRA, not like big change, still 7,000. If you're age less than 50 years younger, if you're older than 50 years, it's about 8,000. So if the one thing I would like to draw attention next is called catch up. So that's the good news. That's the good news for people at the age 60 to 63. This is new. It's new for this year. So normally, like we have additional contribution for 401k. We have additional 11,250, and which it can contribute total is 34,750. So if you do the simple IRA, you have additional, it's called catch up, 5,250, which you can contribute 21,750. So is any of you or people around you at the age 60 to 63, that's the new and also the good news. We can make more contribution on our retirement. So, I mean, some of you will think about besides our regular 401k or SEP IRA, we would like to contribute on the transitional IRA. So the one thing I would like to draw attention, yes, for the income, maybe phase out. So it depends on the transitional IRA and the Roth IRA. So here's the table for the phase out on the things on here. So for example, with Mary Fan Johnny, and we have income over 146,000. So we might be able, not phase out on the transitional IRA. So here's the table next. So is anyone know about the QBI? QBI is called qualified deduction, income deduction. So in overall, we get 20% deduct on our net income. So 20% QBI deduction remain for most of the realtors. And there's a phase out limit increase for high income earner, which I'm going to go through later. And also I would like to talk about the strategy to maximize the QBI deduction or minimize the self-employment tax next. So here, what is a QBI? QBI is called a qualified business income deduction. So that allow self-employed people like us, or have the pass-through entity like LLC, S Corp, partnership, can deduct 20% of the net business income. Keep those in mind. Those 20% deduction not apply to the people who have W-2 employee. So the deduction is based on the net profit. The net profit, that means that after the expenses, before the self-employment tax. So we will get 20% deduction on the QBI. Next. So let's take a look at the numbers here. Lisa is a realtor. He making 100,000 net profit. So net profit means that he making a gross minus all the deduction. They come down to net profit 100,000. So so times 20% is 20,000 deduction. So that means that his taxable income instead of 100,000 is going to be 80,000 on her income. Yeah, next. So here's the table for the taxable income limit deduction for 2024. And as of today, 2025 hasn't come up yet. So I believe the number should be same or slight increase if the number come out. So we can share with the 2024 the information. So if you take a look, we have the two things. Like if you're single, if your income above 241,951, you might not be able to deduct 20% of the QPI. So for example, for this year, I'm single, and I'm making 300,000 on the taxable income. And I'm not able to deduct 20% of 300,000, which is 60,000, because the income is too high. The income is above 241,951. So you lose the deduction 60,000. And we can have the next slide. Yeah, go ahead. Yeah, so it's the self-employed qualified deduction. So this one is the QPI. Yeah, next. So next one, we talk about the self-employment tax, and also we talk about how to lower down your taxable income, so that way we can qualify 20% of the QPI. For us, we have the self-employment tax. You know that that's totally 15.3%, including 12.4% Social Security and 2.9% Medicare. So this applies to all the self-employment income. And one thing I would like to draw attention, if you're a high earner and you make a lot of money on the commission side, and you might have to add on the additional 0.9%. It's called Medicare tax. So that means that if you are single, the income over 200,000, and if married jointly, and 250,000, besides the 15.3%, you have to pay the additional 0.9%. So the possible solution, maybe we consider we set up a S corporation to lower down the self-employment tax. So which I have the case example later. Next. So here's one on example here. So for most of the realtor operate as a sole proprietorship. So you know that when you come down to Schedule C, and we had to pay 15.3% self-employment tax on all the net income. So the beauty for S corporation, I give you a big picture. For the beauty of S corporations, you don't need to pay all the net income for self-employment tax, as long as you pay yourself reasonable amount salary. This example here, John is a realtor, so he making 150,000 as a sole proprietorship. So when come down to tax side, he had to pay 22%, 22,950 for the self-employment tax on the Schedule C. So if he go to S Corp, keep those in mind. John had to pay himself reasonable amount salary. So which about this one in this case is 80,000 on the salary. So another 70,000 is called like the K1 or distribution. The 7,000 is not subject to the self-employment tax. So that means that he's only paid the employment tax only 10,500. So that means that by going to the S Corp, he's saving the employment tax is about 11,000 in this case. One thing I would like to draw attention on here. So when people set S corporation, we had to pay ourselves reasonable salary, because if you don't pay yourself reasonable salary, and as when they come down the audit, they ask you to pay back all the self-employment tax. So example here. So if they're making 100,000 And maybe most of us thinking, I don't want to pay any employment tax. So I pay myself $0 or $10,000 and another $140,000 as the owner distribution. And do you think as when they come down the audit, they will let you go? Normally no, because you have to pay a reasonable salary for that. Next. The other technique we're using as a realtor, sometimes we can control the income timing. And also we need to do the expense planning. So example, we had the deal close on December 30. And you might get a check now next year, or you have the chance to ask them, get you the check in 2005, because most of us on the cash basis. So if we don't receive the check will be reported for next year. So we have the option of flexibility. It's possible can work with your broker and to shift a little bit on the timing on the income side. Yeah. So for example, like Mary expecting a 40,000 commission in December. He might or she might can delay the closing until early January if possible. So that way they stay below the QBI. As I mentioned that the QBI have the income limit. If for that year, I do recommend that at the end of like November, and we sit down, we take a look how much income we make for the year. And do we over the limit? If we over the limit, two things we can do. One is on the income side. Can we delay, postpone a little bit on the income? So maybe the examples, just like maybe it's possible can delay the closing, or we can expedite expense for the year. So all this happen is plan ahead. It's not they come down after December 31st, you finish, and then you come down to come to the tax preparation. You ask the preparer, punch all the number. If this case, we are on the honest system. If nobody audit, everything we done is correct. If we come down to audit and then find out you like don't do a good job, and then they might have some penalty on that. Yeah, and next. So we can take a look to maximize realtor like deductions. So I know that I'm a little bit out of time. I'm going to go very quick here. The first things I would like to draw attention is home office deduction. Home office deduction. So most of us use the home office deduction. When come down to audit, so the home office deduction, you don't need to have the dedicated room. We only have the dedicated area. So for example, I use this corner as my home office. So as long as I don't have the personal on this one, we can qualify as a home office. So let's take a look what we use for the home office. We do managing the transactions, and sometimes we use the client meetings, and sometimes we do the marketing, and we do the bookkeeping, or some administrative work. So in other and home office, we have to be regularly for the home office. Next. So like common use desk, we normally use a desk for home office. Next. So for home office, there are two ways to do the calculations. One is called simple method. The other one is for actual method. So the simple method is $5 per square feet up to 300 square feet. So for this one, the good things is you don't need to check all the home related expenses. And one beauty for this one, no depreciation recapture with this method. So examples, if we use the home office 300 square feet and the home is 3,000 square feet. So when come down to when you sold the house, if you use the actual, all the depreciation had to add back, and you have to pay back the depreciation. And also, that portion home office is not qualified for the Section 121. So, and if you're thinking you're going to sell your house in the future, and in the next few years, maybe I would recommend that you use the simplified method, which is about $5 per square feet. So that way you can avoid the depreciation recapture for this method. This one is best for the small home office with low expenses. Next. This one we use the actual. That means that everything related to the home we can deduct. And the key point is portion. What's the percentage of the home used for the business side? So, and we including the direct expenses. Sometimes we painting the office and we repair in the office area. And also we have the indirect expenses. We pay the mortgage, we pay the property tax, and we pay the utility, we pay the insurance, and also depreciation. And for this method, it's best is for the larger home office or have high home related expenses. Next. So here's the like comparison from the home office. So the home is about 2,000 square feet. The home office about 200 square feet, which is 10% for the business use. So we had the mortgage interest, utility insurance about 24,000. So we had deduction. Let's take a look two methods. Simple methods, $5. So times 200 square feet, which 1,000. We use the actual expense method, which 24,000 times 10% is 2,400. In this scenario, we use the actual expense. It's better off than the simple method. But again, if you plan to sell the house in the near future, I do recommend that we use the simple method. Yeah. Next. So the most things we're using as the realtor expense is the vehicle expense. So I mean that's the purpose for us when come down to audit, and they ask the margin law on that. So our purpose, sometimes we show the property to the clients, meeting with the buyer, seller, and the partners. And we travel to the lenders. I know that we have the mortgage lender here, so we travel to lender desk and also business deduction. And also we attend real estate networking event like today. When you come to here, morning section, the mileage is the business mileage. And also on the rental property. Yeah, next. So there are two methods. One is called standard. Use this like this year we're 70 cents per mile. This is the easy auction. So one thing, this one just checking on the business mileage and tie 70 cents. So for example, you drove 11,000 business mile, you tie 70 cents, which come down to 7,700 deduction. Next. Next. So the other method is the actual. The actual, that's for the high cost vehicle. So we have the very expensive vehicle, maybe 70,000 vehicle. Maybe we look into the deduction, use the actual. So we deduct the actual cost and based on the business usage. So the actual cost, including the gas, oil change, repair, insurance, and also lease payment. If you own, we can do the depreciation. So one thing I would like to draw attention. Let's take a look at example first. We have the cost expense is 9,000. Like we usage about 75%. And in this case, we can deduct 6,750. One thing I would like to draw attention, between those two methods, one's used the standard one based on the mileage, the other one based by the actual one. If you use the mileage, you cannot switch to actual. Yeah. Next. Here's the travel expense. Next, I know that I'm up time. I go through very quick. Again, I will give the slide. So later, if interested, you can ask the association for the copy of slide. Next. This is called the travel. Next. Yeah. And one thing I would like to draw attention for travel, what they I would like to avoid as reflect in the travel deduction. So what's the common trigger the audit? Keep those in mind. when you travel, leave the hotel, even though you pay $1, please keep the receipt. Please keep the receipt for hotel. The reason why I asked the auditor, why you very strict, my client just pay $60 for the hotel, why you ask for receipt? Because that's the requirement for them. Because maybe some people maybe buy something from the hotel and charge to the hotel room. So that's the reason they need the receipt to identify what the charge for. So if you travel, keep the receipt. And also, some of the refer is you claiming your personal vacation as the business trip. And also, we large meal deduction without proper records. So maybe the best practice for us is keep the receipt and keep the record. And each get the habit for each receipt, and at the back of receipt, write down who we have the who, what, when, where, and why, and also have the business purpose. So some of the business purpose is attend meetings, conference, and the property visit. And also, if you mix with the business and personal, and it's okay, but you only deduct on the business portion. So, for example, I know that we have the international event. Some of you might be travel to Asia to have the business event. And after we travel, we might stay Hong Kong, Taiwan, or Beijing for like visit the family. So in that case, we take the portion and the business portion. And for example, the airplane is 100%. The hotel, you only deduct the day you do the business travel on the conference over there. Yeah, so let me know if I'm out of time. So the next one, I talk about the high audit risk area for Realtor, and also how to avoid the IRS. So because when I prepare this one, I have a lot of things I would like to talk, but I know that I only have 30 minutes, so I'm out of time. So here's the key things. Keep those in mind. With the AI, do you know that on the Schedule C, we fill down, it's called business code. They have the 7-digit number, you put those in. Business code. So with that code, and right now on the back end, they can run the ratio. They can run the ratio. I can share with you some of the secret number over here, but it's not official yet. So I just, with my experience, I see some ratio over there. And some people deduct more than the income. So yeah, I understand that, for example, we're making the commission 20,000. And we have the mileage deduction about 19,000. I mean, you might be argue with me because it's new. They're new. They need to drive a lot to see the client. But that's why they draw attention to IRS. They come down to see you why. Why you making 20,000, you drawing 19,000. That's why they trigger the audit. Yeah. And also, the other things, a bit expense not matching the income. And also one thing is what unreported income and cash transaction. So now, right now, how many of you receive 1099 NEC? Good, that's good, that's good. So do you know that when they give to you, the same thing, they report to IS. So because right now they have the database, that's what the AI. That's AI. So they correct all the information. So that's, for example, you receive 300,000 1099 NEC. In your tax return, you report 200,000. So that draws the attention. They come down see you. Why you misreport the income? So again, I'm a little bit out of time. So I have more things I would like to discuss. So if you need me to come down, I'm willing to come down next time and to talk about the different area with my audit experience. One thing I would like to draw attention is I see that some secret number go down a little bit. So yeah, so right now, normally they use the expense ratio around 30 to 40%. Expense. So So that's the things on that. So if more than that ratio, that's fine. As long you have the business reason, you have the document to back up, we should be okay. But at least we don't want to draw attention. And I mean, your time should be spent more time with your client. Should not be get the stress and prepare the document for IS. Yeah, I think, thank you so much for your time. I mean, as I mentioned that I have a lot of things I would like to share, but I mean, I'm a little bit out of time. Thank you.
Thank you, Jeff, for your wonderful and informative presentation. I'm pretty sure we have a lot of questions here, and but we don't have enough time to answer them. So if you could stay a little bit after the meeting, you have a chance to speak with Jeff directly. And also, please contact Jeff if you have any text questions. On behalf of the West and Gabriel Valley Realtors, I would like to thank our guest speaker for a very informative and knowledgeable presentation. And we have a very small token of appreciation. Please join us next week as we welcome attorney Jim Klinkert, who will be giving us a 2025 legal update. Thank you, everyone, for joining our meeting today, and have a wonderful day. The meeting is now adjourned. If you have any tax questions, please stay for Jeff Huang, JH CPA, to ask him personally, directly. Thank you.